All right, let's talk about one of the coolest parts of investing, actually getting paid by the companies you own a piece of. Yep, we're diving into the world of dividends.
So what if you could get paid just for owning a piece of a company? I mean, literally, they send you money just for being a shareholder. Sounds pretty great, right? Well, that's exactly what dividends are all about. Okay, so let's break it down. What is a dividend really? It's probably the simplest way a stock can pay you back. And understanding it is, well, it's pretty key.
Honestly, it's exactly what it sounds like. A dividend is just a payment a company makes to its shareholders, and it usually comes right out of their profits. Think of it like this. The company did well, made some money, and now they're sharing a slice of that pie directly with you. Because hey, you're an owner.
So when a company turns a profit, they basically have two choices. They can take that money and plow it back into the business, to grow, innovate, expand. Or they can give some of it back to you, the shareholder. It's a big decision for them.
Let's put some real numbers on this. Say a company pays out a 30-cent dividend for every share. If you own 100 shares, boom, $30 lands right in your account. Just like that. It's cash in hand, a direct reward for being an investor. It's funny, it's not just about the cash. Investors often see dividends as a sign of a company's strength. It's like the company is saying, hey, we're doing great, our earnings are solid, and we're confident about the future. It's a huge signal of stability.
Okay, but how do you actually get the dividend? It's not as simple as just owning the stock on any given day. No, it's all about timing, and you've got to pay attention to some key dates.
Really, it comes down to three things. Number one, and this is the big one, you have to buy the stock before the ex-dividend date. That is the absolute cutoff. Miss it, and the person who sold you the stock gets the cash. Next, there's the record date, which is just when the company officially checks who owns what. And then, the best part, the payout, when the money actually shows up.
All right, so the dividend cash lands in your account. Now what? You've actually got a choice to make, and it can make a really big difference in the long run. So you've got two main paths here. You can just take the cash payout, it gets deposited into your account, and you can spend it, save it, whatever. It's immediate income. The other option is something called a DRIP, which stands for Dividend Reinvestment Plan. This is where you tell your broker to automatically use that dividend money to buy more shares of that same stock.
And this is where the magic of compounding really kicks in. With a DRIP, you're buying more shares, which then earn their own dividends, which then buy even more shares. It's this awesome snowball effect that can seriously boost your returns over time. But just a heads up, it does mean you're putting more of your eggs in one basket, which can increase your risk.
Now, how do you measure how good a dividend really is? I mean, if one stock pays $1 and another pays $2, the $2 one is better, right? Well, not so fast. To really compare apples to apples, we have to look at something called the dividend yield. So what's dividend yield? It's just a percentage that tells you how much you're getting back in dividends each year compared to the stock's price. It's the perfect bang for your buck calculation. It shows you what kind of return you're getting on your money from dividends alone.
And the formula could not be easier, seriously. You just take the total dividend they pay for the whole year, and you divide it by the stock's current price. That's it.
So, using that example, we get a dividend yield of 2.6%. And that single number, that percentage, is what lets you compare this stock to, well, pretty much any other investment out there.
And that's really its superpower. With dividend yield, it doesn't matter if a stock costs $30 or $300. You can compare them on equal footing. You can even use it to see how a stock's income stacks up against something totally different, like a bond. It just levels the playing field.
Okay, it's easy to get excited about all this dividend income, I get it. But, and this is a big but, it's not a sure thing. There are definitely some risks involved, so let's talk about what you need to watch out for.
And this is probably the most important thing to remember. Dividends are not guaranteed. A company can decide to slash them or even get rid of them completely whenever they want. They are under zero obligation to keep paying you.
So, a few things to keep on your radar. First, if interest rates go up, suddenly safer things like bonds might start looking a lot better, making dividend stocks less attractive. Second, as we just said, there's always the risk of a cut. And when that happens, watch out, because the stock price usually takes a hit too. And finally, you got to be careful with super high yields. If a dividend yield looks way higher than its competitors, that can actually be a red flag that the payout is in danger.
So what's the big takeaway here? Look, dividends can be an absolutely fantastic way to generate income, and they can be a great sign of a healthy, stable company. But they are not a free lunch. You, as the investor, have to do your homework and really understand what you're getting into.
Which leaves us with one last really important question. We know past performance is no guarantee, so how can you tell if a dividend is actually safe for the future? What are the clues that show it's not just high, but that it's healthy and sustainable? Figuring that out, well, that's really the secret to being a smart dividend investor.